Stephanie Link, chief investment strategist at Hightower, recently joined CNBC to share why she believes we're still in the early stages of the AI boom and why that could mean the stock market has much more room to run. She also explained why investors should start looking beyond just big tech as AI begins driving growth across more sectors of the economy. In a moment, I'll play you Stephanie Link's interview uninterrupted, then I'll break down her key points, share my own take on what she got right, and finally reveal 3 top growth stocks that could be well-positioned to benefit from this next phase of the AI revolution. Let's hear what Stephanie Link has to say.
Let's bring in Stephanie Link, Chief Investment Strategist and Portfolio Manager for Hightower.
Morning.
Also a CNBC contributor. Let's do it for the 3rd time here, Steph, and tell me whether it makes sense. Because what did Forrest Gump say? I'm not a smart man. So 400 on the S&P. For earnings in next year, 2027. If you take 20 times earnings, is like it's a round number. That's 8,000. Is that reasonable after the gains we've already seen in the S&P?
I think so, Joe, and I think it's because the economy is really healthy, led by the consumer, led by the AI revolution, and that's leading to a broadening out in the market into different sectors, because it's not just technology that's going to benefit from AI and the revolution. It's a lot of other sectors are starting to do well. And in fact, last quarter, 7 out of 11 sectors had double-digit earnings growth. But technology took all the credit, right? So I think that we're going to continue to see a widening out of the market. I think you want to own tech, but you also want to own industrials, financials, especially discretionary, with oil prices down 40% from the highs. I think there's a lot to choose from.
It can't be that easy, though, Steph, can it? Just 20 times 400? What is... It's hard to say.
You know what, Joe?
If interest rates go up, you don't get 20 times earnings. So I understand that, but trying to figure out what the multiple should be doesn't seem like that's going to help. But what could go wrong with the 400? And is there downside risk or upside risk? What's more likely on the 400 in earnings?
Well, I think the bond market's telling you that we've already seen peak inflation, which is really very, very positive. And again, that's positive for a lot of sectors, a lot of people, consumers, which is 70% of the economy, but it's also businesses and their input costs. So if inflation has peaked and it's coming down, I know it's not at the 2%, where the Fed wants it to be, but it's coming down. We were running 2.5% in February pre-war. So if we get back down to that, that's really very manageable and, again, very positive. So I think that there's upside to earnings. In fact, I actually thought this year we would see 10 to 12% earnings growth. We just put up 26% last quarter, and we're going to probably do 20% this year. I think we are in the early stages of the AI boom. A lot of sectors are benefiting, and at the same time, the consumer's hanging in there because they have a job and wages are actually still around 4.5%. So a lot is good out there.
The interview begins with an interesting discussion about market valuation. The host throws out a fairly simple calculation. If S&P 500 companies collectively earn around $400 per share in 2027 and investors continue valuing those earnings at roughly 20 times earnings, then mathematically you arrive at an S&P 500 level around 8,000. Now, on the surface, that almost sounds too easy. Markets are never that straightforward. But I actually think the exercise is useful because it forces investors to focus on what ultimately drives stock prices over long periods of time. It is not headlines. It is not politics. It is not social media excitement. Eventually it comes down to one thing, and that is earnings. Stephanie immediately says she believes that scenario is reasonable, not guaranteed but certainly achievable. Her confidence comes from what she believes are 2 powerful engines driving the economy right now. The first is the American consumer. The second is the AI revolution. I think this is an important point because many investors make the mistake of believing AI only benefits companies making chips or building data centers. Stephanie is arguing something much bigger. She believes AI becomes a productivity tool that improves profitability across almost every industry. Personally, I think that is probably the biggest investment theme of this decade. When new technologies first emerge, investors tend to focus only on the companies creating the technology itself, During the internet boom, everyone wanted internet companies. Eventually, investors realized retailers, banks, logistics companies, manufacturers, healthcare providers, and countless other businesses became more valuable because they successfully adopted the internet. AI could follow a very similar path. Instead of asking which company builds the smartest AI model, investors may increasingly ask which companies use AI most effectively to increase productivity, reduce expenses, improve customer service, and generate more profit. That is a much broader investment opportunity. Stephanie then talks about something that I think deserves much more attention than it usually gets. She says the market is beginning to broaden. For much of the last couple of years, it has felt like only a handful of mega-cap technology companies were carrying the entire market higher. Investors became obsessed with the largest AI winners while ignoring many other industries. But according to Stephanie, that picture is starting to change. She points out that 7 out of 11 sectors posted double-digit earnings growth last quarter. That statistic is incredibly important because it suggests corporate America is performing much better beneath the surface than many investors realize. Technology grabbed all the headlines, but many other businesses quietly produced impressive results. That is usually what healthier bull markets look like. Markets become more sustainable when leadership expands instead of becoming concentrated in just a few names. I actually agree with her here. Whenever only a handful of stocks drive market gains, investors naturally worry about what happens if those few companies stumble. But if industrial companies begin growing, financial companies begin growing, consumer discretionary businesses improve, healthcare continues performing well, and technology remains strong, then suddenly the market has multiple engines instead of just one. That creates a much stronger foundation. Stephanie specifically mentions industrials, financials, technology, and consumer discretionary as areas she likes. Again, there is an interesting connection here. AI does not only increase demand for semiconductors. Industrial companies are building factories, automation systems, robotics, electrical equipment, and infrastructure that support AI expansion. Financial institutions increasingly use AI to detect fraud, analyze risk, automate operations, and improve customer experiences. Consumer companies are using AI to optimize inventory, personalize marketing, streamline logistics, and improve efficiency. The ripple effects become enormous. One thing I appreciated about her comments is that she is not saying investors should abandon technology. She actually says investors should continue owning technology while also expanding into other sectors. That is a much more balanced approach than simply chasing whichever stock has AI in its business description. The conversation then shifts toward valuations, which is probably one of the biggest debates on Wall Street today. The host acknowledges something many investors worry about. Even if earnings continue rising, valuation multiples matter. If interest rates stay elevated or move even higher, investors may become less willing to pay 20 times earnings for stocks. That concern is completely valid. Higher interest rates generally reduce what investors are willing to pay for future earnings because safer investments like bonds become more attractive. Stephanie does not dismiss that risk. Instead, she shifts the conversation back toward earnings. She essentially argues that while valuation multiples fluctuate, growing earnings ultimately provide the strongest support for stock prices over time. I think there is a lot of wisdom in that perspective. Too many investors become obsessed with predicting whether the market deserves 19 times earnings or 21 times earnings. Meanwhile, they completely ignore whether businesses are actually becoming larger, more profitable, and more productive. History shows companies that consistently grow earnings usually reward patient shareholders regardless of short-term valuation debates. That does not mean valuation never matters. Buying great companies at absurd prices can absolutely produce disappointing returns. But over long periods, earnings growth remains the primary driver. The next topic Stephanie discusses is inflation, and this is where her overall bullish thesis becomes even stronger. She believes the bond market is signaling that inflation has likely peaked. That is significant because inflation affects almost every corner of the economy. Consumers pay higher prices, businesses face higher costs, profit margins become pressured, interest rates remain elevated, investment decisions become more difficult. If inflation gradually moves lower without causing a recession, that creates a much more favorable environment for both businesses and consumers. Stephanie notes that inflation does not necessarily have to fall all the way back to the Federal Reserve's 2% target immediately. Even returning closer to previous levels could provide meaningful relief. That is an important distinction. Markets often react more to the direction of inflation than the absolute number itself. If inflation steadily moves lower, businesses gain more certainty, consumers regain purchasing power, companies can plan future investments with greater confidence. Investors also begin anticipating lower interest rates over time. All of those developments support higher corporate earnings. Personally, I think inflation remains one of the biggest variables investors should continue monitoring. While recent trends have certainly improved compared to the inflation surge we experienced previously, unexpected shocks can always emerge. Energy prices could change. Global conflicts could disrupt supply chains. Tariffs could increase costs. There are always variables capable of changing the outlook. So while Stephanie's optimism is understandable, I also think investors should avoid assuming the inflation story is permanently solved. The discussion then turns toward corporate earnings, and honestly this might be the strongest part of her entire argument. Stephanie says she originally expected earnings growth around 10 to 12%. Instead, companies delivered 26% earnings growth during the previous quarter. That is a massive difference. Even more impressive, she now believes earnings growth for the full year could approach 20%. That matters because earnings are ultimately what justify higher stock prices. Think about it this way. If companies continue producing record profits year after year, then higher stock prices become much easier to justify. Investors sometimes forget that markets are not simply numbers moving across a screen. Every share represents ownership in a real business generating real cash flow. If those cash flows continue expanding rapidly, the businesses themselves become more valuable. That is exactly the foundation of Stephanie's argument. Her optimism is not built purely on hope. It is built on accelerating corporate profitability. She also repeats something I believe is worth emphasizing. She says we are still in the early stages of the AI boom. That statement carries enormous implications. Many investors already believe they have missed the opportunity because technology stocks have risen so dramatically over the past couple of years. But if Stephanie is correct, then we are still relatively early in the adoption cycle. The infrastructure is still being built, companies are still experimenting, business models continue evolving, productivity gains are only beginning to appear. That suggests the largest economic benefits may still lie ahead. I actually find that argument convincing. Whenever truly transformative technologies emerge, adoption rarely happens overnight. Electricity took decades. Personal computers took decades. The internet took decades. Cloud computing took years before becoming mainstream. AI will probably follow a similar pattern. The first phase rewards companies building the infrastructure. The second phase rewards businesses successfully implementing the technology. The third phase rewards consumers through lower costs, improved products, and greater efficiency. We may only be transitioning from the first phase into the second. That could mean the investment opportunities remain much broader than many people currently appreciate. Of course, none of this means investors should blindly chase every company mentioning AI. There will undoubtedly be winners and losers. Some businesses will overpromise and underdeliver. Others will quietly transform themselves using AI without attracting much attention from Wall Street. Those may ultimately become some of the most rewarding investments. Overall, what I took away from Stephanie Link's interview is that her optimism rests on several interconnected ideas rather than one single prediction. She believes the economy remains resilient because consumers continue spending. She believes inflation is gradually becoming more manageable. She believes corporate earnings are exceeding expectations. She believes market leadership is expanding beyond just technology, and perhaps most importantly, she believes artificial intelligence is still in its early innings, creating opportunities that extend far beyond the companies making headlines today. Whether every part of that outlook plays out exactly as she expects remains to be seen, but I do think her framework gives investors something much more valuable than a short-term market prediction. It encourages us to focus on the long-term drivers that actually create wealth. Growing earnings, improving productivity, expanding innovation, and disciplined investing have historically mattered far more than trying to predict every twist and turn in the market. Now, let's dive in and talk about the 3 growth stocks that could be setting up for massive long-term gains as some of the biggest trends shaping the global economy continue to accelerate. Let's begin with the first stock on our list, Plug Power, ticker symbol PLUG. If there is one company that perfectly captures the phrase high risk, high reward, it is Plug Power. The company has spent nearly 3 decades pursuing its vision of a hydrogen-powered future, yet despite all that time, it has never consistently generated a profit. For years, many investors questioned whether hydrogen fuel cells would ever become commercially viable. Today, that conversation is finally beginning to change. The reason is simple. The world needs cleaner and more reliable energy solutions, and hydrogen is becoming an increasingly important part of that conversation. Hydrogen fuel cells generate electricity by separating hydrogen into protons and electrons, producing power with water as the primary byproduct. That makes the technology attractive for applications ranging from industrial equipment and commercial vehicles to backup power systems and even energy-hungry data centers. What makes Plug Power particularly interesting is that it is no longer just a fuel cell company. Management has spent years transforming the business into a complete hydrogen ecosystem. The company manufactures electrolyzers that produce hydrogen from water, supplies hydrogen fuel directly to customers, develops fueling infrastructure, and even sells electricity generated by its own energy solutions. That diversified approach gives Plug Power multiple ways to grow as hydrogen adoption expands. More importantly, the business is finally showing signs of meaningful progress. Revenue increased by 13% last year, while the company's net loss declined by roughly 20% compared with the previous year. Higher margin businesses, including hydrogen sales and power purchase agreements, are becoming a larger percentage of total revenue, helping improve the company's path toward profitability. Management believes Plug Power could reach profitability by late 2028 if execution continues improving. I think this is where many investors overlook the bigger picture. The market often focuses on Plug Power's history of losses without recognizing how much the business model has evolved. The company is no longer relying solely on selling equipment. It is building recurring revenue streams while positioning itself across multiple parts of the hydrogen value chain. If hydrogen becomes a larger piece of the global energy transition, companies with established infrastructure and industry expertise could have a significant head start. The long-term opportunity is certainly compelling. Industry forecasts suggest the global hydrogen market could roughly double by 2035, while the fuel cell market itself is expected to grow at an average annual rate of about 25% over the same period. Those projections help explain why investors continue paying close attention to Plug Power despite its past financial struggles. Of course, this investment is not without risk. The company still needs to improve margins, reduce losses further, and prove it can consistently generate profits. That uncertainty makes Plug Power more suitable for investors with a higher risk tolerance and a long-term mindset rather than those looking for quick gains. Personally, I think Plug Power represents one of the more interesting turnaround stories in the clean energy space. If management delivers on its profitability targets and hydrogen adoption accelerates as many analysts expect, today's company could look dramatically different several years from now. The risks are real, but so is the potential reward, which is exactly why Plug Power, ticker symbol PLUG, earns the first spot on today's list of top growth stocks to buy now. If this resonates with you, you're exactly who this channel is for. Please, hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second stock on our list is ServiceNow, ticker symbol NOW. At first glance, ServiceNow might seem like an unusual growth stock to buy right now. The stock has pulled back significantly over the past year, and many investors have become concerned that artificial intelligence could actually hurt the company's business. After all, if AI can generate code and automate workflows for free, why would businesses continue paying for enterprise automation software? It's a fair question, but I think it completely misses what makes ServiceNow such a powerful business. The biggest misconception is that companies simply want automation. They don't. They want automation that is secure, reliable, scalable, and capable of supporting thousands of employees across an entire organization. That is a completely different challenge than asking an AI chatbot to write a few lines of code. ServiceNow has spent years building enterprise software specifically designed to automate complex business operations. Its platform helps organizations streamline workflows across departments, improve employee productivity, manage IT services, and eliminate repetitive tasks that consume valuable time. Once these systems are deeply integrated into a company's daily operations, replacing them becomes both expensive and disruptive. That creates one of ServiceNow's greatest competitive advantages: high switching costs. When businesses depend on a platform to keep critical operations running, they rarely want to take the risk of changing providers unless there is a compelling reason to do so. That gives ServiceNow an incredibly loyal customer base, and the numbers certainly support that idea. The company generated nearly $3.7 billion in first quarter non-GAAP revenue, representing 19% year-over-year growth. Even more impressive, its subscription renewal rate has consistently remained at or above 97%. That tells me customers are not only staying with the platform, they continue finding enough value to renew year after year. Personally, I think that may be one of the strongest indicators of a quality business. Revenue growth is important, but recurring revenue backed by exceptionally high customer retention is what creates truly durable companies. It gives management greater visibility into future cash flows and allows the business to continue investing in innovation while competitors struggle to win customers away. Another reason I'm optimistic about ServiceNow is that artificial intelligence may actually strengthen its business instead of replacing it. Rather than competing against AI, the company is integrating AI directly into its own platform to make workflows even smarter and more efficient. Businesses still need trusted enterprise software to manage sensitive data, maintain compliance, and ensure mission-critical operations continue running smoothly. AI simply becomes another tool that enhances those capabilities. I think that's a much stronger long-term position than many investors currently appreciate. The market appears to have focused too heavily on the potential threat while overlooking how ServiceNow can use AI to make its existing products even more valuable. Companies that successfully combine enterprise software with artificial intelligence could become some of the biggest winners over the next decade. The growth outlook also remains encouraging. Management expects strong momentum to continue throughout the rest of the year, supported by increasing demand for workflow automation and enterprise AI solutions. The company is also consistently recognized as a leader in enterprise application software, reinforcing its position as one of the industry's most trusted providers. That leadership is one reason many Wall Street analysts continue to rate the stock as a strong buy. The average price target remains more than 30% above its recent trading level, suggesting analysts believe the recent pullback has created an attractive buying opportunity for long-term investors. Of course, no investment is without risk. ServiceNow still trades at a premium valuation compared to many traditional software companies, meaning investors will expect management to continue delivering strong growth. Any slowdown in revenue or customer adoption could put pressure on the stock price. But when I look at the bigger picture, I see a business with a durable competitive moat, recurring subscription revenue, outstanding customer loyalty, and a rapidly expanding opportunity as businesses continue embracing digital transformation and artificial intelligence. To me, this looks less like a company being disrupted by AI, and more like one that's using AI to strengthen an already outstanding business model. That is exactly the type of company I like to own for the long term. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The third and final stock on today's list is Marvell Technology, ticker symbol MRVL. When most investors think about the artificial intelligence boom, they immediately focus on the biggest names in the industry. But one of the best ways to generate outsized returns is often to look beyond the obvious winners and identify the companies quietly supplying the technology that makes AI possible. That's exactly where Marvell Technology comes into the picture. Marvell designs the critical semiconductor solutions that help power modern data centers. Its portfolio includes networking chips, Ethernet controllers, digital signal processors, storage connectivity products, and increasingly, custom AI processors. These may not be the products grabbing headlines every day, but they are absolutely essential to the infrastructure supporting artificial intelligence. Think of it this way, building an AI data center isn't just about installing powerful processors. Those processors must communicate with each other at incredible speeds, transfer massive amounts of data, and operate with maximum efficiency. Without advanced networking and connectivity solutions, even the most powerful AI systems cannot perform at their full potential. That's where Marvell has carved out an important niche. What I find particularly exciting is that Marvell isn't trying to dominate every corner of the semiconductor industry. Instead, it has focused on becoming an expert in specialized technologies that are becoming more valuable as AI infrastructure grows more complex. One development that really stands out is the company's involvement in designing custom AI processors. As demand for artificial intelligence continues growing, more organizations are looking for chips specifically optimized for their own workloads, rather than relying entirely on standard products. That trend creates an enormous opportunity. Marvell has already demonstrated its ability to partner with major cloud providers by helping develop custom AI processors that can be tailored to specific applications. As more companies pursue specialized AI hardware to improve performance and reduce costs, Marvell's engineering expertise could become an increasingly valuable competitive advantage. the numbers certainly suggest the business is moving in the right direction. Last year, Marvel increased revenue by more than 40% while returning to profitability. That's an impressive achievement considering many technology companies are still navigating a difficult economic environment. Even more encouraging, analysts expect another period of strong revenue growth over the next 2 years, with earnings per share projected to more than double as operating leverage improves. To me, that combination of accelerating revenue growth and rapidly expanding profitability is exactly what long-term investors should be looking for. The long-term market opportunity also remains enormous. Industry forecasts suggest the market for AI computing infrastructure could continue expanding at an average annual rate of roughly 25% through 2035, eventually reaching hundreds of billions of dollars. As artificial intelligence becomes more deeply integrated into businesses across every industry, demand for faster networking, more efficient data movement, and specialized computing solutions is likely to increase alongside it. I also think Marvel benefits from something many investors underestimate. Artificial intelligence is no longer an experimental technology. Businesses are actively investing billions of dollars to build the infrastructure needed to support future AI applications. Even if spending experiences occasional slowdowns, the long-term direction appears very clear. Organizations continue demanding greater computing power, larger data centers, and faster networking capabilities. That plays directly into Marvel's strengths. Of course, investors should recognize that semiconductor stocks can be volatile. The industry moves in cycles, customer spending can fluctuate, and expectations are often extremely high. That means the stock price could experience significant swings along the way. But for patient investors, those periods of volatility can also create attractive buying opportunities. Personally, I like companies that are positioned behind major technological shifts rather than simply benefiting from short-term excitement. Marvel is helping build the infrastructure that allows artificial intelligence to scale, and I believe that gives the company a compelling long-term growth story. When I look at all three companies we've discussed today, I see three very different investment opportunities. Plug Power offers exposure to the growing hydrogen economy with meaningful upside if management successfully executes its turnaround. ServiceNow provides a high-quality software business with exceptional customer loyalty that is embracing artificial intelligence rather than fearing it. And Marvel Technology gives investors exposure to one of the most important pieces of the AI infrastructure build-out through its advanced semiconductor and networking solutions. Each company carries its own risks, but each also operates in markets with tremendous long-term growth potential. That's why I believe these three businesses deserve a place on every growth investor's watch list. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I'd like to hear from you. Which of these three companies do you believe has the strongest long-term competitive advantage? Is it Plug Power's position in the hydrogen economy, ServiceNow's dominant enterprise software platform, or Marvel Technology's role in powering the AI infrastructure boom? Let me know your thoughts in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.